CCUA for partnering with us on this event. We are so excited to be here and talking to you about all things women and the great wealth transfer. I'm Crissi. I'm the founder and CEO of Penny Finance. Um, I'm here because growing up, my mom and grandmother worked extra hard, yet still lived paycheck to paycheck. I promised myself that wouldn't be me. After college in Boston, I studied finance and accounting. I landed a job in New York in private wealth, got my own apartment, thought I was on my way, ended up still living paycheck to paycheck all 10 years in New York. And I think that's the reality for most people in America. Um, for me, I realized after all that time and being surrounded by smart, capable, amazing women who are all working because we were told to get a job and everything would be fine, I realized that that wasn't the solution to creating wealth and creating financial freedom. So I quit. I decided I want to change that 4 years ago. I left my job in private wealth to start Penny Finance. We are a company founded to help close the wealth gap and provide online financial planning and education to women. So the reason we're here talking to you is because we serve almost 30,000 women and have learned so much over the past 4 years about how women need to be served differently. And so today, the reason we wanted to have this session is the news and the headlines are really pointing to this huge wealth transfer. It's all the buzz. It's all we hear about. Women are going to stand to inherit all of this wealth. Everything's going to be fine. We're all good now. We don't have to worry anymore about the pay gap, the wealth gap. Well, we want to go beyond the headlines today. We want to dig deep and show you what is behind this wealth transfer, what this really means for women at large of all ages and generations, and what we're seeing in our demographic of women, because we are not seeing what these headlines are actually showing. And we think that this is really important, particularly for credit unions who serve a significant population of women in terms of how we need to support women going forward. I'm going to go through a couple facts and then into an agenda, but we have a really intimate group here today. I would love for this to be interactive. We have this is going to go over a report that we did among 5,000 women and what we've learned. But please put in the chat questions, anything you want us to dig into. We obviously can't go through the full report today. We're going to share it afterwards. But again, just please ask tons of questions during this. Our goal is to educate you. What is this transfer? Who is it going to impact? And how we think holistically about serving these women. So what are the facts? $84 trillion, which is a significant sum of money, and assets are going to be handed down to millennials and Gen X over the next 10 years. This seems like a huge sum of money, right? We're going to dig into who's getting that money and who is it really going to impact, because I think that's super important for the demographic you all are serving. By 2030, which is only a few years from now, American women are expected to control the majority of boomer assets. And when you look at that stat, you're like, oh, wow. So I think today already, if we look at credit union data, most of your customers are women, but this should grow even larger. The question is, are those your women? Are those women who bank at credit unions, or are those women that bank somewhere else? Why women? Why is this happening? Well, we know women live longer, 5 years on average. So that is generally one of the main reasons that there is this transfer of wealth, right? You inherit the wealth as someone passes, but you also keep the wealth longer because you are living longer. 30% has been the increase in the past 5 years of married women making household decisions. We know historically, it's like 83% of consumer spending decisions come from women. We knew that. But when you look at financial and investing decisions in the household, it's largely been men. This has changed significantly. But then there's another big piece of this, and the reason why I think we're seeing these big, sexy, crazy headlines about the wealth transfer is that Women usually switch financial advisors and primary financial institutions within a year of their partner dying. So for this piece of it, when you look at the financial industry, the wealth management space, the financial advising space, this scares a lot of people, right? You don't want to lose your existing clients, but it also excites a lot of institutions because they think, oh, well, maybe this is an opportunity for me to attract new business. A woman decides, and we're going to go into this, a woman looks at different factors when choosing their financial provider compared to men. And so this is an opportunity as well as a concern, right? You don't want to lose your clients. So are we good? We have this $84 trillion in assets that's moving hands. A lot of people think this is going to solve, everything's so expensive and inflation and the wage gap. Well, the reality is healthcare expenses are going to eat up a significant portion of this wealth. This quote from Fast Company, I think, sums it up the best. Billionaires and other high net worth households will see most of their assets passed down, but those who are not from wealthy households are likely to see most of that money eaten up by healthcare expenses. So first takeaway for us is yes, there's this big transfer happening. Yes, women are going to be the inheritors of these assets, but number one big red flag to us is healthcare. And we know that. We know how you live longer, you likely are going to have healthcare expenses. What else? What else do we need to know about this great wealth transfer? Well, it's mainly going to impact the already wealthy. What Alex and I did when we did put this report together is our first question we wanted to answer was, well, which women are getting this money? Right? Everything's all like, okay, 84 trillion, next decade, da, 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 da. Well, only 15% of American adults are expected to receive an inheritance. So what's the flip side of that? 85% won't. 68% of the wealth transfer will go to households that already have $1 million in assets, right? And only a small portion of households already have that kind of wealth. The average inheritance, when we take that $86 trillion, the average inheritance that is going to move wallets is $46,000. So that's a good sum, but it is not life-changing. Our takeaway and what we're going to dig into now with our report is for the 136 million Americans who bank with credit unions, the financial realities are largely the same with or without the transfer. So we wanted to say, instead of asking how to serve the next generation of wealthy women, because we actually don't think that's going to necessarily happen for most, we asked and dug into in our report, how can we serve the next generation of women with and without wealth? Because that's the majority. And at the end of the day, you have to think about where are the majority, and the majority are actually without wealth. So that's what we're going to dig into today. What did we do? We serve at Penny almost 30,000 women. Our report dug into 5,500 women, average age 34 years old. The high level stats are here, and then I'm going to go into like what we're going to cover, but we wanted to know, what do women really want? What do women really need? What are women really dealing with? And what are the opportunities to serve them? I see a couple people in the chat. So one second. The average age is 34 years old. We did in this cohort of 5,500 women that we're going to dig into today and report on, we did have women 18 to 75 years old in 4 different generations. 65% have anxiety about money. Average savings, 89,000, 3,000 average monthly spending. 59% don't invest, 53% want to invest. Half are moms, 66% in debt. So we wanted to just put this out here so you know, high level, This report that we're going to dig into and share our insights on focuses on women who have less than $100,000, who are not necessarily investing, who are moms, who have debt, which is generally matches the everyday American. I actually think this amount of savings is a little bit higher than the average American, but this is who we're focusing on. Let me just peek at the chat and see if there's any questions. Jessica, with more single women already owning houses, are these women looking towards real estate? Yes, we'll get to that. That's one of the questions that we focus on in the report. Okay, so what's today's agenda? What are we going to focus on? Just to take a little pause, when I'm fundraising for Penny and meeting with investors, the number one question I get is, what do women really need different financial support? Do they need a different service? And the answer is yes, they do. They think about money and finances very differently. And not only do they think about money and finances very differently, but their financial picture is much different. So yes, we need a different playbook. And what our goal for today is take you through the data, go through how we think credit unions can support this next generation of members. And then we promised a little bit of financial advice in the back end because everybody loves that. And it was every session I do, no matter what the topic is, whether it's a money workshop or like a fireside chat, everyone always wants financial advice. So we're gonna, at the end, just weave a little bit of that in. Okay, here's the report results. Who are the women we surveyed? The 5,500 women. 4 generations, like I said, women who are 18 to 75. These are we segmented the data in this report by generation. The boomers, Gen X, millennials, Gen Z. As I said, the average age, so most of our members in Penny are millennials. Average age in Penny is 34. That doesn't mean we do have statistically significant data across all 4 generations. I just want to make that clear, even though the biggest cohort of our members in this survey are in the millennial population. So first, let me take you through some of the numbers. And I know that this is a lot. Most of the data we're reporting on is not going to be in chart form like this, but I think it's really helpful just to see the data side by side. Where are these women that we surveyed in terms of their wealth? Where is their money? Where are their assets? Where are their debts? If we first start with retirement balances, you'll notice Gen X and boomers, and we know this because this is like very apparent in the world, they do have a good sum of money for retirement, but that's not going to be enough, right? We have a retirement crisis. We know that. Millennials this is the biggest opportunity, right? It looks like a small number, $69,000. But if this were to be invested, this number could be $1 million at boomer level. So when we look at the data, it's very clear to us that the millennials are best situated for retirement, but we need to dig into if they're investing or not. We have to think about Gen X and boomers and think about what are they going to do. When you think about the wealth transfer, let's go back to the topic of today. Okay, $300,000. When this boomer passes, is there really going to be a significant amount of money to pass down? This boomer probably can't even retire, right? Or is living very frugally, hopefully has a pension or Social Security. The numbers that we see and everyday people we serve are very different from the headlines of the wealth transfer. And that's really what we're trying to get at today in reporting these results. Average savings balances, they're very similar to the retirement balance numbers. Ironically, we thought that these would be a lot lower. The boomers have this sum of money that's sitting in a savings or checking account. You'll see when we get to the investing stats, was because they're not investing the money, but they have this. So if you add these together, maybe someone on average has $600,000. That's a really good sum of money. But it's not set aside for retirement, right? And if you look at the Gen Z, $14,000. This matches what we see in the average press around Americans. Like people usually have $25,000. Debt. Millennials and Gen X have the most significant amount of debt. We know this because of student loans. More since the 80s, women there have been getting more degrees. That means more student loans. That means more debt. What is interesting, and what I think you will all be, it would make sense to you, is even though the millennials and Gen X have larger debt and loan balances, Gen Z is paying the most in loan payments. Interest rates is a huge function of this, right? But largely, if you look at loan payments across the board, they are similar, just Gen Z is a little bit more. Let me check the chat.
Question from Melissa in the chat,
Yep.
Crissi, does debt loan balance include mortgages here?
No, does not. When we ask people to report debt and loans, everything but mortgages and car loans. And the reason we do that at Penny is because mortgages and car loans are set up for you to pay them off, right? Car loan 6 to 10 years, mortgage 30 years. Personal loans, student loans, credit cards, medical debt, we worry about those because there could be a chance, and you look at these numbers down here, that you never pay it off because it's not set up for you to pay it off. Good question. So this doesn't include homes. And one of the things we'll talk about in a second is like with the wealth transfer, we have to talk about the debt transfer too. What about mortgages that are going to be passed on to the next generation? Can they even fund that mortgage, right? Or do they have cash flow left off at the end of the day? We don't know. Average monthly spending, we're not surprised. The millennials are spending the most. But this doesn't mean, I think a lot of people think millennials are frivolous spenders and are just spending all of their money away. This is not because of that. When we look at money goals and what people are focused on, it's not, they're worried about their future. So we'll dig into that a little more. This bottom part is what I'm worried about the most. When I think about serving women and helping them build wealth over time, is the debt picture. You look at the loan, oh, I make an $800 loan payment. That's probably, that to me, I'm like, oh, they can do that. Well, this worries me the most. Most people are going to be debt-free 35 years, 36 years, 31 years, 27 years. Percentage with debt. Look at millennials and Gen X, 71% with non-mortgage, non-car loan debt. The bottom line is really, really troubling. Based on when we did this report, we asked for interest rate, loan balance, and payments. We're able to calculate when you will become debt-free. 21%, 28%, 25%, 19% will never pay off their debt. So they're making these payments, but we'll never erase this debt. That is problematic, especially when you think about the wealth transfer. If 20% of boomers are not going to pay off their debt, that debt, unless it's, yes, credit cards and student loans do not pass on, but other debt does. And then the next generation is going to inherit that. So we just wanted to sort of like zoom out and see, okay, what are the actual numbers and what are people working with? Because that'll help us to figure out how to serve them. Let's dig into, there's like 5 or 6 topics we wanted to dig into as part of the report that we thought are helpful and different from what we expected to see. So money goals by generation. Very consistent across the board. Women are focused on their future. Over 75% of every generation. My future, my future, my future, my future. What do I need to do to build wealth and retire? The second biggest generally is debt, which makes sense, right? Go back, look at the data. The majority of women have debt. They're focused on how do I solve that? That burdens them when thinking about increasing the other side of the balance sheet. For boomers, what is very different from boomers from the other generations, which we think is helpful when you think about your customers and your members, is boomers are mostly focused with self-care, probably with the healthcare bucket and aging and longevity. but the other generations aren't really. Millennials are second most focused on buying a house. They want to buy a home. Most of the millennials and Gen Z are not homeowners yet. They want to be homeowners. That is their number one goal, but their debt is burdening them from doing that. And yes, to the point made earlier, single women are buying houses at a faster rate than any other demographic. I think the number was like 33% when you look at the Chase report. That's fabulous, but it's not all women, right? And if you look at the data, almost 50% of the millennials in this cohort are focused on buying a house. It's lower than all of the other sectors. On spending, I just want to make one point on this, right? Millennials, 3,500 in spending. You think that's significant? We thought when we'd look at the money goals, we'd see millennials and Gen Z, like the media portrays them, focused on self-care, travel. Not really. They're focused on future, home, and debt. Money feelings. This is a good one. It's not surprising at all, but there's just a few call outs I think might be helpful for you as you're developing products and services for members. Anxiety across the board of all all demographics of women. Number one feeling when they think about money, love is not present at all. Women do not love money. Boomers feel more, they reported security more than any of the other populations. And as I think that we can, if we look back at the numbers, it's because they've amassed a little bit more, right, than the younger populations because they're later in their life. But shame is one that comes up more so for millennials than any other generation. And that's unfortunate. And so that requires, if it's anxiety, shame, all these negative emotions, that requires a different way of serving them, right? Men don't feel this way. And I have some data on men, so you can put this together and see like the stark differences between the two. But it's a very different conversation, a very different vocabulary, a very different toolkit we need to help women with their money because of this immense amount of anxiety, shame, and fear, which leads to very little confidence and some opting out and avoidance of tackling your money. Job type. This one's not surprising, but it's very important. We know when we look at this data, right? Boomers have the most, almost 20% not working. And when we ask people this, it wasn't like, are you retired? It's like, have you worked in your life? Of course, as generations have moved on, there's been more working women in the workforce, right? Majority of the workforce is women now. We know that. But where are they working? That is what, if you look at the generations, Gen X, hourly self-employed entrepreneurs, 20%, less than 20%, millennials, 20%, Gen Z, 30%. So each generation that moves on, more and more people do not have the salary full-time jobs, do not have access to the employee-sponsored retirement accounts, do not have access to the HSA, FSAs, do not have access to healthcare benefits that are subsidized. This is really important because it is very different to serve someone who doesn't have a W-2, doesn't have an employee-sponsored retirement account, especially in home buying and lending, than it is someone that does have that W-2, does have that salary full-time job, does have maybe different levels of AGI on their tax returns because running a business is so different than having a full-time job. This is super important. You have to talk to each of these groups of people by age in a very different way, right? So I think it's super important to just track where this is going. And of course, Gen Z, there's a population that are students, and I know a lot of you have particular programs, especially for students, but the big takeaway here and the way that we think about this is You serve women in a different way, and then you serve people based on what life stage they're in, what type of job they have, what type of financial situation they are in a different way. Everyone needs something a little bit different, which is important. Okay, investing. These slides make me really sad, really frustrated. This is what keeps me up at night. This is why Penny was born. I was shocked at this data about investing. I was not shocked with the debt piece. We know people have been, we have these amazing degrees, advanced degrees. Of course, we're gonna have more debt. This shocked me. If you look at people's retirement accounts and if they are invested or not, and this was not us actually looking, Penny does have a product where we look into accounts and see what they're invested in. This is women self-reporting back to us saying, we said, are your retirement accounts invested? They could say yes, no, some are, not yet, or I'm not sure, because that's a big piece of this. Some people, they're like, how do I even know? Look at the boomers. Over 60% say yes, my retirement accounts are invested. Every generation after that, down, down, down. Gen Z, like less than 30%, half. Okay, so the wealth gap, we're basically at half. Women have half the wealth of men. In my world, this is terrifying, right? Because how have we gone backwards? We have the internet, we have unbelievably amazing resources. We now have financial education in high schools and at least 12 states in America. How is it possible that we've cut in half the investment rates of generations? This is where we're going to get into a lot of trouble, no matter if there's a wealth transfer or not, no matter whether you inherit wealth or not. If you're not investing that money, you're not going to grow the wealth, right? Second thing that is surprising is people who are not sure if their accounts are invested, again, have gone up over the generations. You look at this, like 10%, 15%, 20%, over 20%. You'd think with access to amazing tools, unbelievable resources, hundreds of fintechs, hundreds of robo-advisors, like how is this possible? This is something we need to focus on together, because this is going to prohibit women from growing their wealth and graduating into this bucket of financial freedom. To double click on this, we said, okay, well, we know your baseline. Are you investing or not? Well, do you want to? Like, who's investing? Do you want to? If you are investing, who's investing? Because at the end of the day, this isn't black and white. This is hard. It's an intimidating space. There are tons of different ways you can get invested. What does it look like? So across the board, even with the boomers, almost 40% in all categories are not investing but want to. This is very different from, no, I'm not, and I need to, I really don't want to, right? Like, it'd be much harder to, talk someone into doing something they don't want to do, right? These groups want to invest, so we're failing them in some way. The people that have no interest whatsoever, boomers, it's interesting, there's a significant portion that have no interest, fine, but it's very low when you look at the other generation. So there's appetite for this. People want to learn, they want to invest, they want to know how. And then if you look at the generations of who is investing, the boomers most have a wealth advisor and most love picking stocks. Very interesting. Very few have robo-advisor. Makes sense. New invention. You look at millennials, largest cohort to have robo-advisor. That's good. But why is it only 10%? Right? There's so many tools for auto investing and that have really democratized investing, but people aren't using them. So one of the questions we all have to ask is, okay, what is the solution then here? If it's not the tool, it's not the invention, it's not the ability to do it, then what is it? Switching gears to debt for a second. These are the same numbers you saw in the first chart. percentage of women who will never pay off their debt. Very similar across all of the generations, almost 30%. This means, like, if you back into what this means they're servicing their debt for no reason. Of course not, you don't want to default on your debt. Like, we're not going to say just don't pay that money, but that you're really throwing away the money. And this is largely because personal loans, student loans, credit cards, they allow you to make a minimum payment that's lower than what is required to pay it off. Also, some people just don't have that monthly amount they need to pay off the debt. This is a huge opportunity. It is solvable because if we look at the debt numbers, like go back to the beginning, 60,000 in debt, 74,000 in debt, 49, 37. You look at the payments, like if you back into the payments of these numbers, even with a high interest rate, they're serviceable. The women have the discretionary money to cover them. So it's the focus on how do we get them to the right payment amount. And then savings. I think this is the last slide and until we move on to like the big takeaways and what we can do. Average savings by generation. Really interesting to see millennials up here with saving $600 a month, even though they're spending $3,500 a month. That's really good. Gen X is saving the most, $725 a month. Boomers are saving $500 a month, and then Gen Z, 300. Makes sense, right? They're young. They probably are barely making enough to pay their bills, but they're saving. Okay, like they're not, this isn't zero or negative. We have a lot of people in our community are negative savings every month. They're pulling out of their savings every month. This is a very strong indication to us. Women are saving, which means they have the dollars. So what does that mean for the debt? They have a little bit extra they can put towards the debt. And if they're saving, that means that they can be investing and that they can be growing their wealth. So, but these are the real numbers, right? Like you look at that 84 trillion in the wealth transfer, and it's like, for me personally, I just can't, I look at that number and I'm like, that's just not real. Like we can't focus on that in that big headline. We focus on the individual who's saving $600 a month. That's the reality in America. Okay, to sum it up, and then I'm going to pause and take some questions from the report data. What do we see? Millennials want to buy homes. But because of debt and other factors, they're doing so later, right? They're spending a ton of money every month. They are saving, but they're servicing debt. They're buying houses later. The next generation of women will have access to different retirement resources, different benefits resources. And even if they have access to them, they're not taking advantage of them. You'd imagine with an employee-sponsored retirement account for, what was it, half the population, more than half, 60% of the population of millennials and 40% of Gen Z, where most have auto investing options, most have target funds. Why are people not taking advantage of that? So there's a huge gap here in terms of people not taking advantage of the resources that they have. And then third, all groups want to invest, but unilaterally are not. And we think that's because they lack the confidence, education, and the right sort of introduction into this space to take the first step or even understand that they need to be doing something. There's, of course, additional takeaways from this. Debt is a huge piece. Women are not paying off their debt. They're never going to pay off their debt. There's a huge opportunity there. But these are the three big things we're seeing, which are contrary to the buzz, contrary to what we're seeing, that this wealth transfer is going to enrich women. Well, is it really? We don't think so. I'm going to pause there and see if there are any questions about the high level report results. And that was just a sampling. We have a full report and we'll send it to you afterwards. But those are the big pieces we wanted to share with you in terms of just getting your hands around. Where's the money? What do people's financial picture look like? And then you as leaders at the credit unions can back into, okay, how do we serve this population? Questions? See one in the chat. Do you find that millennials are seeking a second source of income to accommodate their spending? That's a really good question, Bree. We did not ask that in this survey. That's a really good follow-up that we can do, which is, it was a question, what type of job do you have? And they pick one. I would imagine that a lot of people have side hustles and a lot of people have additional sources of income, but that is not included in this report. Good question. Okay, priorities in what we do. We think there's 3 opportunities: debt, saving, investing. Home buying, of course, is a whole separate bucket, but we're going to focus on debt, saving, and investing. I want to dig into debt just a little bit because it's not as easy as, okay, our women have these debt, let's like, they have the debt, that is what it is. This is very nuanced, and we know it's because women hold 2/3 of the student loan debt in the United States. They hold significantly more debt than men. So when you're serving women, it's a little bit of a different lens. Women are really smart. We focus on, okay, well, why would I start investing? I need to get rid of the debt first. I need to focus on the debt first. Well, it's not as black and white as that, right? And there's lots of things we can do to service our debt. So one of the ideas and one of the takeaways from the session is, with the debt that you have, you can have a different repayment plan. You can consolidate. You can seek forgiveness. You can enter into the save plan that the Biden administration came out with. You can consolidate all your credit cards into a personal loan, et cetera, et cetera, et cetera. There are a lot of things that you can do. Women have the appetite for these products. They want to know, they feel they're one of their second largest money goal, debt. You offer education consolidation, better rates on loans. This is a huge opportunity for credit unions. With a combination of your digital channels and your human support, we think that this should be top of mind for you as you're thinking about serving women in the next generation. They have more debt, they have more student loans. How can we support them in getting out of debt more quickly? Because what that means, they can save at faster rates and they can get into investing, get out of debt into investing, right? We're going to take you through an example of a woman in our platform because I think it's really helpful to just think through, like, how do you actually help the person, right? Here's a quote directly from someone in our platform. I graduated with a master's degree, mountain of debt. My repayment plan is 10 years. Now, yes, that's not too bad, but it's keeping me up at night. When will I buy a house? I'm single, I'm 30. What if I need to pay for fertility treatments? Where do I even start to figure this out? So I think people become paralyzed because they're like, okay, I have this debt, I need to pay it off, but I have this goal of buying a house. What do I do? So some ideas: eliminate the shame, more loans, more debt. This is what it is. Okay, you're paying off this debt in 10 years. It is what it is. Doesn't mean you can't buy a house. Address their options. Can you do the save plan? Cut down that payment plan. Loan forgiveness, consolidations. Is it high interest? Is it not high interest? Your mortgage lenders are the best. My home loan is with a credit union. Sometimes, even though you have the student loan debt, if your debt to income ratio is less than 43%, well, great. You can maybe still buy a house. Do you have the cash flow to buy a home even with the student loans? Like, people just, they need help connecting the dots and putting the pieces together and just understanding, what are my options? Can I do this? Is this good? Is this bad? And then the third thing, which I think is so important, is repayment periods and minimum payments. Like I said, the questions we asked in our report were around debt where you have the ability to change the payment. The mortgage, you can't. With a car loan, you can't really, unless you refi, or you change upfront on the loan. You're like, okay, instead of P&I, I'm just going to do interest only. Well, with student loans, which is the majority of the loans we're talking about here, this is the situation that most women, 25% of women, fall into. They're paying $400 if they paid $40 more, $100 more, they could actually pay them off, and they might get in the bucket of never paying them off, right? You have options, you have flexibility, but it's not black and white. And this is where women get paralyzed. They're like, well, I just need someone to validate this for me. We're going to give 2 more examples of like, what is the real stuff that people are dealing with and how can you help them? The next one I think is an absolutely huge opportunity for credit unions. Women are saving. We saw the savings rates, right? But only 9.8% are putting that money to work in a high yield savings account or a CD. To just sitting in a checking account, not earning interest. You're their trusted community bank. You offer high yield savings accounts and CDs at better rates than some of you in the big banks. This is a huge opportunity, and one that we look at, what's behind the reason women don't invest is because they're not educated. They don't understand what it is. They think it's too risky. Well, we think the first place to start is with high yield savings accounts and CDs, a wealth building tool. You grow your wealth. Yes, this is going to change in the coming years when rates go down. But why are only 10% of people taking advantage of these amazing tools when they have the savings in the bank? Here's an example. I've been a Penny member for 2 years, and because of what I learned, I made 3.5K in interest on a high yield savings account. I had never heard of one and had concerns about money and if it is safe. Now I am proud my money is working for me. What can we do? We need to identify all the checking account customers. You know who those are through customer data, open banking tools. We can see that and use technology to figure out who is missing out on growth by leaving their savings in a checking account. This is an opportunity to grow wealth with an existing customer base and attract new people. And educate. I think that there are a lot of misconceptions about high yield savings accounts and CDs. Is there a catch? Can I lose my money? Is my money locked up? Of course, with the CD, there it is. But we just need to be proactive in general with this community because they just don't understand what it is. And then third, leverage the branch locations. Credit union members trust their banks 2 times more than traditional banks. Of the 30,000 women we serve at Penny, 80% bank with credit unions. They're already customers. They trust their credit union. This is a huge opportunity. Okay, the last example. Third, and this is the harder one. But because a lot of credit unions offer retirement accounts, IRAs specifically, or sometimes wealth management, we think that this is really important to dig into. Only 33%, according to Fidelity, 33% of women see themselves as investors. You are women too. 70% of credit union employees are women. You offer the retirement and financial planning support via IRA digital tools. The group of people in the industry, the banking industry, that are best positioned to change this, to help women see that they are investors. They're really good investors. The data shows women are better investors than men if you look at all categories, from money manager to hedge fund manager to individual investor. This is going to be a huge team community effort to help women build the confidence and the tools so that they see themselves as investors and they know what they need to do. And we go back to these numbers that are, oh my God, they're just driving me crazy. Over 40% of people want to invest, but they don't know how. This is solvable. Here's an example, and I love this one because Bank of America is the culprit. I had no idea opening a retirement account was only one part of the process. The money needs to be manually invested, yes. Bank of America never mentioned to me or notified me that my money was sitting in cash in my Roth IRA. I already feel like I'm behind as a 52-year-old, and this made me feel extra overwhelmed. This is solvable. This is how we give better client service. This is how we get more women invested. This is how we have people growing their money. Investing education, and we're not talking about posting blogs. Nobody wants to learn about money. They want to learn about their money, what they want to do. Your cash in your Roth IRA is not invested. If it was invested, this is what it would look like. we hear from people all the time, just tell me what to do. Just tell me what to do. I'm ready. I'm willing. I want to learn, but just tell me what to do. Retirement readiness. This is huge. We go look back at the data. If we don't get our millennials and Gen Z investing and focused on retirement, they're going to be in a worse position than the boomers. And then we're not talking about wealth transfer. We're not talking about wealth gap. We're talking about a major crisis among all generations that no one has enough money to live. This can be automated. This can be scaled. And we're not saying like hire an army of financial advisors at every credit union in America. That's not what is needed. It's basic retirement readiness. Okay, 52-year-old, invest the money in this account. Here are your options. And then the step 3, which I think is a huge opportunity, especially for new revenue for credit unions, is facilitating the rollover and facilitating the inheritance, if there is one. There is a huge cohort of uninvested, dormant retirement savings that are sitting in old accounts. The younger generation switches jobs more than the boomers. We would love for you to be the primary bank when the transfer happens. You get that IRA rollover. The inheritance happens, you keep that wealth at your credit union. We need to do this. In order to do this, there is a ton of education, marketing, and life event targeting, right? We need to know where people are at. If they're not switching jobs or inheritance is not happening soon, it's just going to go in one ear out the other, to educate the silent generation, which is before the boomers, and the boomers before they pass. Let's make sure everyone knows that you offer these services if you do. Okay, we are at 11:45. I'm going to pause here for a second. Any questions digging into these examples of quotes we got from the report and ideas that we have based on the work that we've been doing over the past 4 years in this community around what women need, ideas for how you can serve them? Melissa, do you see community education as a way to start addressing the need? There are a lot of small, mid-sized credit unions that don't offer investment services, but do offer CDs and high yield. Is this a good place to start? Yes. Even if you don't offer IRAs, even if you don't, maybe you don't have mortgage lending, what everyone will always need, no matter what, is a checking and a savings account. And in a savings account, the easiest way to get a woman to start growing and building their wealth is through a high yield savings account and a CD. And yes, it just starts with education and awareness that these products exist, what they do, how to use them. Like, is there a minimum transfer? Can I get my money out when I need to? It starts there. And I think, Melissa, yes, of course, education, but I would, we need to like think about, we can't just talk at people about their money because they're getting that from everywhere, right? And that hasn't solved the problem here. People want to learn about their own money. And I think it starts with whoever faces off to these members. So all the employees of credit unions need to be trained on this and how to properly educate their members that these products exist, and not in like a yucky salesy, like, hey, open this account, you'll get a bonus. It's like, hey, I see I'm the bank teller. I see you have $50,000 in your account. Have you thought about moving it to a high yield savings account so you can earn money on that? Like little things like that, in the spirit of customer service and helping our customers. We just need to be a little more forward with, look at women tell us, just tell me what to do. Unless someone is in their face, or they get an email, or they see a pamphlet in the branch, they're not going to do it. And they're only going to do it when they hear it from someone they trust. So yes, education for sure, but I think it needs to be like really, like we need to think about, like, we can't just like do an event and expect everyone to open an account, right? This is going to take like some hand holding to get across.
I tried to get through this whole hour without talking, but just to elaborate on that, Crissi, I think one of the things you brought up that, you know, may resonate with some of the credit unions. So when you say not just talking at people and not just saying, hey, we have a CD, hey, we have this product, there are a lot of ways to promote those products. So now with all of the different, applications that are out there and fintechs that are out there to do that AI-driven cross-selling and marketing. I mean, there is a whole population of credit union members that, if approached the right way with a cross-selling marketing campaign, can be made aware of that first step, which is the high yield savings and the CDs that may be available. And it's a in-person conversation. It's a one-on-one consultation, but it can also be an email that comes out,
email
a
campaign,
postcard in the mail. And
yeah.
then I think part of it is kind of getting, some of the credit unions to think a little bit differently, and potentially this is a population that is not only in need, and it's a credit union's responsibility to make sure we're serving all members, but this is an opportunity for credit unions as well, I think, because you don't hear that often, gender-focused marketing. You just don't. But being able to describe the statistics, which you pointed out, and some of them I think are alarming, absolutely alarming, are concerning for the future of our different generations. I will comment that I was glad to see Gen X on there, and I think we're going to be the saviors of all generations. But
yes, please.
absolutely. But no, I think that commenting on it's not just education, but looking at different tools and collaborating on what they could be for the marketing approaches is
right. And there's a way to scale it, but like, people want to feel like you are looking out for them and it's for them and you see them. And so like, that's the biggest thing, is like, how do you capture somebody's attention? Because they're getting credit card offers in the mail, they're getting ads left and right, but like, they trust credit unions. And so you're already a step ahead. It's about meeting them where they are, knowing what they're going through. Hey, we know you're servicing your debt. We know everything's so crazy expensive. Like, you could earn $4,000 by putting X into a high yield savings account. It's totally different than like, open this credit card, you're gonna get a bonus. Like, that is going to excite somebody, and they're going to pay attention to that.
Yep.
Okay. So I promised we'd spend 10 minutes at the end. I'll go through even quicker on some practical advice for steps to build wealth. This is just some fun for the end. I'm sure many of you know this, but maybe you don't. So 1, boosting savings. An example of what Melissa and I were just talking about is there's many ways to boost savings, to unearth cash flow. And we can figure out there's so many APIs and open banking tools today where you can actually figure out and do at scale some like target marketing through your customer list of like, oh, actually this cohort of people, they can earn a significant amount by moving it to their high yield savings account. This to us seems like a no-brainer, but it is a very hard thing to do. Like, you can't just send one email and say, open a high yield savings account, right? Like, there's behavioral changes that need to be made. And to boost savings, we really need to be talking to people about funding their emergency savings, boosting their savings, creating separate accounts by goals, and just helping people understand the big picture, right? What does it mean for them and their money? No, you can't just say open a high yield savings account. It has to be something like, you're going to earn $4,725 by moving your money to a high yield savings account. Managing debt differently, calculating your own payment. I touched on this a little bit, right? What do you need to be paying on a monthly basis to get this $40,000 loan amount with a 6% interest rate gone? $700 a month is 5 years, and let people choose their own ending. I think that one of the biggest things we learned in this journey, especially with women, is, the whole just tell me what to do. Well, the problem with personal finances is there is not always the one answer. There is not always a right answer. A lot of it is around what makes someone feel good. If they pay it off in 10 years versus 5 years, that's a decision the person needs to make, right? There's no person on the other end who can say, this is the number, right? So we have to empower people with the tools, the resources, the support, so they can make the best decision for themselves. But it starts with educating them on, most of the people who we surveyed who are never going to pay off their debt, they had no idea, right? So it just starts with helping people see their financial picture in a different light. Refinance debt in the coming years when rates come down, consolidate credit debt, negotiate medical bills, consider the SAVE program. There's so many things you can do to manage debt differently, but what we're seeing is this avoidance opt-out mentality because it's just so overwhelming. Like the last thing someone wants to do is go log in to their student loan servicer website and look at the total amount they have due, right? It's so intimidating. People need a nudge. They need a little hand to hold. They need a little bit of help thinking this through. And if we can connect it with their big goal, which is you want to buy a house. We know you want to buy a house. Let's figure out your debt so that you can buy that house and not be over the threshold of your debt to income ratio. Planning for retirement. We love to show this slide because I think, again, like one of the hard nuances with saving and planning for retirement is it's such a long-term thing. When you're 25, you're living paycheck to paycheck and you have all this student debt, it is very hard to put your brain into your 65-year-old body, right? But what we have to do is help illustrate that you will have to save less if you start earlier, right? The 22-year-old that puts $500 in an account and invests it is going to have the 1.5 million at retirement. If you wait till 32, you're older, you're wiser, you're making more money, have more discretionary income, that number's cut in half. If you wait till you're 49, it's a really tough spot. We always say you can't out earn time. You cannot out earn time. And this is something that, like I said, what's so scary to me is you'd imagine this 22-year-old and 32-year-old would have been told by the world, new resources, their parents, past generations, you gotta do this, you gotta do this, you gotta do this. Well, it doesn't seem to be the case. And these folks are investing less. So what's going to be more of a reality is this bucket. And we need to somehow illustrate this to people through education, tools, and resources. This is what we want. We want this 22-year-old situation. How do we get there? And then the last thing, we get the question all the time when we talk to people in companies and employers and financial providers and even consumers. Well, you tell me to invest. Like, what does that mean? It seems so risky. I can't take risk. I'm taking care of my kids. I have aging parents. I have this debt. Da, 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 da. One of the things that I think is a misconception out in the world is people think investing is day trading, crypto, single stocks, options trading. It's not, right? It is investing in a diversified stock and bond portfolio through ETFs, mutual funds, and target funds. Almost, I'd say a majority of the employee-sponsored retirement accounts or even IRA fiduciaries have auto investing, have incredibly, improved UIs that allow you to select these investments more easily, but it's not happening. So we need to demystify this. And one of the things we have found to be one of the most effective tools in helping everyday people learn about investing is the first rule of thumb. You invest for your age. Your age should in some way match the percentage of bonds in your account. So as you get older, you get more conservative. The last thing we want is a 67-year-old to have 100% of stocks in their account and we have a down year and you're in a tough situation. And so all of this education, all of this like digestible, easy to understand financial education, but couched in their situation. You have this IRA account. It's not a Roth, it's a regular. This is what that means. This is your percentage stocks and bonds. Da, 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 da. There's a bajillion tools and amazing providers out there that can help you do this at scale. This is one thing that women want. 40% of women want to learn how to invest. So as a credit union, one of the things you have to figure out is how am I going to offer this to them? To wrap it up, this is solvable. Women are working and they're saving. They have the money. This was 40 years ago, this wasn't happening, right? Women weren't making the money. They didn't have money to their name. They weren't even able to get a mortgage, right? They weren't even able to open a credit card. They're working, they're saving, check. They want to solve the puzzle. They want to invest, they want to pay off their debt, they want to take care of their family, they want to put the pieces together, but they're so anxious, so shameful, and so overwhelmed, they don't know what to do. And they already bank with you. So if we can connect the dots, then I think that if we read the survey in 5 years, we'd see the next generation is investing at higher rates. The next generation has figured out a way to pay off their debt. The next generation, no, they might not have millions of dollars in their account, but they feel confident with their money. They feel less anxious with their money. And they are going to say, my credit union helped me do that. And in order to get the retention and to attract the next generation, I think that this is an imperative. We have like a couple minutes left, or actually I'm a couple of minutes over. If you want the full report, like I said, we just went through a sampling of the data. Please email Alex on my team. Her email is alex@pennyfinance.com. Alex, if you can put your email in the chat for folks. We're happy to send you the full report. It has even more data that is, it's not as alarming as like the investing in debt numbers I shared, but it is really helpful to think about how to approach women and how to approach different demographics and how to approach different job types, because I think that's really important. And then if you have any other ideas or questions you'd love to learn about women, like Bree asked, let us know, because we do survey our women often. We embed a lot of these questions into our platform so that we can get them on an ongoing basis. And we just want to be able to report back to the industry and where the opportunities are and where we can help. Any final questions? And please give Melissa and team feedback on the session. Our goal was to provide you insights into this demographic that you might not know from your day-to-day.
Crissi, thank you very much. This was excellent. And again, as Crissi mentioned, please reach out to me or to Amy, to our team, if there's any questions, and we can arrange some follow-up. And in addition, Crissi will be joining us at FinTech Connect. So those of you who have heard about that event, which is coming up in June, we will have actually 2 opportunities to hear from Crissi and Penny Finance in the pre-conference session, which will be a very interesting panel discussion about financial planning for the generations, as well as in our cyber showcase, our 3rd annual cyber showcase, which will take place Tuesday morning. We'll get to see a demo and hear all about Penny Finance. So if you guys haven't registered, please do so. And again, Crissi, thank you very, very much for doing this for our membership.
Of course.